Hello. Hi, everyone. Sorry for the holdback. We have some difficulties in technologies previously. Right now, we're ready to begin. One of the speakers is having a bit of problem, and Asha will join us shortly in between when she gets back online. So again, good day, everyone, and welcome to one of the most anticipated webinar organized by Acclaim Group. My name is Alan Ang, Commercial Director for Acclaim. I will be your host for this session today. So a quick introduction about Acclaim Group. So we are a regional professional corporate services provider with an extensive footprint in Asia. We currently have operations in Hong Kong, China, Singapore, Malaysia, Indonesia, Thailand, and Vietnam. The group is still growing and to more countries like Cambodia, the Philippines, Japan, and India. So before we start the session today, we'd like to kick things off with a quick poll to warm things up. So can we have the questions on the poll, please? Right. So we have 3 questions here. Let me just read them out to you. In view of the pandemic, would you consider outsourcing key internal functions moving forward? Yes, no, or no change, no thoughts. Second question, would you be considering expanding your business to Singapore and Vietnam? Third, what would stop you from doing so? That's a multiple choice questions. It could be a current pandemic situation, complex in-country regulations, or costs. Let's give this another 10 seconds. In view of pandemic, would you be considering outsourcing key functions? Would you still expand your business to Singapore and Vietnam? What would stop you from doing so? 5, 4, 3, 2, 1. Right, so poll is closed. All right. We'll share the results again later towards the end, nearing to the Q&A session. So the topic today is all about what you need to know when setting up a business in Singapore and Vietnam. 2 of the most popular countries we keep hearing for quite some time now. Even the pandemic did not prevent entrepreneurs or startups or established enterprises from including either countries into their growth strategy. Today we have with us 2 very inspirational speakers, leaders. Both started off as entrepreneurs in these markets and had established a very successful business for the past 10 to 15 over years. Without further ado, let me introduce to you to our speaker today. Sorry. All right. So our first speaker will be Matthew Laurie, Managing Partner of the Domicile Corporate Services, a partner firm of Acclaim in Vietnam. He'll be talking to you about setting up a business in Vietnam. Our second speaker will be Asha Dixie, co-founder of Money Matters for Expats, now Managing Director for Acclaim Singapore. Both of them were experienced in this industry and will be sharing more insights with you moving forward. And we'll be answering some questions towards the end of the session. Okay, so all right, let's just kickstart with Matthew. Matthew, hello, Matt.
Hi, Alan. So good to be here.
Thank you. This is Matt is really a true specialist when it comes to Vietnam, and he has helped guide multinationals, even government agencies that I've just recently heard, and also startups when they are entering the Vietnamese market. Today, he will talk a lot more about what you need to know when setting up your business in Vietnam, what to look out for, and what are the key items that you need to look out for as well. So if you're ready, Matt, please take over.
Fantastic. So I'm going to start sharing my screen here. Okay. So everyone, I'm sort of looking at how you enter Vietnam and the things to consider. And we hear a lot of difficulties about Vietnam, how hard it is. It's not necessarily easy, but it's not necessarily difficult in most cases. There are some sectors that will cause problems and take time, but I'm here to demystify that a little bit and introduce. This will lead into the Singapore story, because one of the things about Vietnam is how you enter is often through a regional hub, and this will feed back into Ash's presentation and the Q&A, but I'm just going to focus on the Vietnam part for now. So myself as I get here. I've been in Vietnam around 15, 16 years. I'm an Australian chartered accountant originally. I started Domicile Corporate Services, which is the partner for Acclaim and one of the founding members of Acclaim here in Vietnam. And we can skip over. I've worked for quite a lot in country helping out businesses, as Alan said. Domicile in Vietnam has 3 offices, around 70 staff. We provide a wide range of services. So the market entry, structural, company establishment, payroll services, accounting, tax, transaction support, and almost exclusively focused on foreign invested companies. So companies and businesses, the foreign investors. So what are the key things that we need to know as we go through this process? The first thing is approved business lines. You never start anything without understanding the business lines in Vietnam. You can only earn revenue from the business lines you're approved to do. So the fact is that I might have a pen here. Domicile cannot sell you that pen because I don't have a license for retail or stationery. So it's that specific. You need to have the appropriate business lines. Most common business lines are unrestricted. So your consulting, your manufacturing, your trading, things like retail might have sub-conditions or sub-licenses that are required, but you need to understand if they're restricted. And there are some which require a joint venture, as in a Vietnamese party co-owning, such as tourism, travel, advertising. Some of them have 50% maximum ownership restrictions. That travel just has to have a local partner versus things like road transportation must have at least 50%, and others are prohibited. So you need to understand where you're at and what the business lines are. And that's important before you go any further. The sub-licensing is also important, that even if you have the approval, you still may not be able to operate until you meet that sub-conditions, and that might require additional licensing with authorities, and might require a certain staffing, a certain approvals. So understanding them, get that understanding, and then you can move forward with certainty in how the business will work. That's the hardest part. Get that right, everything else just flows. So there's 3 initial steps or 3 initial things you must have in place. Once your business lines, you understand, you've got that clarity, you need to have a legal representative in country, any nationality. It's not about nationality, but one of them needs to reside or generally reside in Vietnam. The law does allow them to be in and out of country every 30 days. However, with current border conditions, that's a bit tougher to achieve. So you can have multiple legal representatives. Often we'll have one in headquarters, one in Vietnam, and there's no nationality. It's simply about where they're residing, physically residing. It's not about citizenship or anything else. The second thing is you must have a fixed place of business, a lease, an agreement to pre-lease, but you must have, what for the purposes of registering with the authorities, you must have a fixed place of business. And the third thing is you must show you have sufficient funds to meet your capital requirements. For the vast majority of sectors, there are no specific minimum capital requirements. Effectively, they start at around $20,000 for a service company, and it will go up from there depending on the size of your business. The idea is the government will approve foreign investors if they bring in sufficient capital to run their business. It is your money. So that $20,000, for example, for a service business, a consulting business, would be your money to use and spend in the business, but it's a commitment that you're making with the authorities to receive foreign investment approval. The documents themselves to support the process do need to be legalised generally in the foreign country. In Singapore, if Singapore was investing in Vietnam, it's a 4-step process, can be done in a day, it goes through 4 different agencies. It gets frustrating sometimes, all the foreign document notarization, legalization. However, that's something that, again, shouldn't be stopping someone from investing in Vietnam. It's easy enough to work around and to deal with that process or get an agent to do that for you. So what are the steps? There's 3 effective stages. Once you've got all that sorted out, there's 3 stages you go through from a timeline. And for most businesses, that's around a 6 to 8 week timeline. If it's an unrestricted business. If it's a restricted or there's other attachments and ministerial obligations, it'll be longer. But for those unrestricted sectors, again, the trading, the service business, the trading business, manufacturing, you can do it in this 6 to 8 week process. Step 1, you need the investment registration certificate, which is the foreign government approval for the investor. That's the most difficult one. So that foreign investment approval, the IRC, does take the most time. It is mountains of paperwork you're signing as part of that, and essentially it's a business plan you're submitting to the authorities using the standard forms. The second step is the shorter one, and all companies do the second step, the ERC, the Enterprise Registration Certificate. That's akin to a certificate of incorporation. So all companies have that ERC, only foreign companies have the IRC. Once the ERC is issued, your company is alive, but then you've got to do the post-licensing, initial post-licensing, which is registering the seal, publishing the notification, etc. And once you do those, you can operate that business. So that's the three steps. Where people get caught out is if there's a particular sector that is restricted, not understanding that, expecting 6 to 8 weeks. Hence those business lines at the start, understanding what those lines are, and then executing does depend on understanding and following through the process there. So this works for the vast majority of businesses. This timeline works. Now, the IRC and ERC, why are they important in the functionality of a business? That IRC, as I said, the Foreign Investment Approval, allows to open a direct capital and investment bank account. That is your foreign bank account for bringing money into Vietnam. And I'll show a slide in a moment, which is why that's important. Opening bank accounts are not difficult. You can do that without being present, provided there is notarized passports and wet signatures, physical blue ink on the application forms. A third party can actually submit them. You can courier them. The KYC for a lot of banks is quite straightforward, and the authorities, we can get local banks to open bank accounts in a matter of days using the same documents as the IRC and the ERC the process. So the ERC is allows opening of the current or the operating bank accounts themselves. So there's two types of bank accounts. There's the investment account for the capital account, and there's the operating account. So we've got to make sure that funds aren't trapped in the process. So the capital that comes into Vietnam from abroad can only be repatriated on disposal or formal capital reductions. There's no minimums, as I said, in Vietnam, but authorities, the minimums depend on the sector and the operation. So I said 20,000 is the common starting point for a service company. That goes up. Loans can be brought into Vietnam and repaid, provided state bank registrations are followed, and that they go through those specific capital account I mentioned. If you bring money into any other account other than that capital account, you will struggle. You won't be able to get those funds out if the loan has come through the wrong way. And dividends can be repaid once per year. So you must have profits and you must have retained profits to send them out. So just to recap, if you want to send money out of Vietnam, you can send profits out once per year. You can send all your loans you're bringing back out, provided they come to the bank account, and you can send your capital back out if you sell the business or do a capital reduction through that capital account. That's why it's really important. It must go through that bank account. Now, to further illustrate that, I've got a little diagram here from the first one. And you can see that direct capital bank account is where the foreign charter capital comes in, the share capital. It's where the foreign investor loans come in, and it's where the foreign dividends come out and the loans come out. That's your border control, and that's a protected bank account. That's the key. Bring money into there, money comes back out. The operating funds or local investors, if you have a local investor, all goes through that current bank account. And so keeping that and understanding allows for this reduction of trapped capital. It's how you run your business, and you can do your treasury planning. You can have your Singapore headquarters and you can do fantastic treasury planning provided you get that right. And that allows for the ability to bring loans, convert loans to capital, do capital reductions, pay your dividends, etc. through that process. So I want to jump into taxation because that's the structural side. It's not as complicated as people think, but it does require planning and thought, and then you can execute and go through the process. So the taxation of Vietnam, how does the taxation work? How does this affect investors? Well, we have a 20% headline corporate income tax rate. There are some benefits reductions available for certain sectors, but as a whole, I would treat that as a 20% headline rate. If there are benefits based upon the fact that you might be in a certain industrial zone or a certain region or a certain sector that might have tax benefits, there are not many, then I take that as a bonus, but I wouldn't make the investment decision purely on taxation. And there are some industries, oil and gas, that you'll pay slightly higher, but 20% for the vast majority of companies. Now, just keep in mind that generally you end up seeing a couple of percentage points higher than that for non-deductibility in many, many cases. So that's something we see quite often. So the value-added tax is another one on that comes in 10%, fairly standard, and that's a standard application. So your exported goods are not subject to 10%. Exported services are not subject to 10%. However, that can cause problematic in trying to do the definition of if you've got related parties, if you're doing services in country. So I just tell everyone to assume that that 10% applies to everything except for exported goods or services where you have confirmation from the tax authorities that they believe that's not at the 10%. And 0 and 5% for certain sectors, certain education, healthcare, etc. Tax rates as an individual. So individual taxes go from 0% up to 35%. The effective tax rate on someone earning about $4,500 per year is around 20% effective tax rate. So just at a point, but it's a sliding scale. Everyone gets a personal deductions and benefits, and they must contribute to insurance. So foreign individuals have to contribute insurances for employment, for health insurance. There are social insurances as well to consider, which foreign individuals only pay part of, and there's also unemployment insurance, which local individuals pay, but foreign individuals do not. So there are additional taxes, and they can be up to 17.5% on the insurances, on the employer side, but they are capped. So after about $1,300, they no longer apply. There's the cap. So 17.5% on the first $1,300 or thereabouts. Non-resident individuals, so those who come in and out of Vietnam and remain resident in Singapore, for example, would be subject to a 20% tax on any earnings. It's quite hard to argue that if you're in country as an individual in Vietnam, because, well, you've sort of been here for more than 6 months, most likely, because there's not many are coming through the borders. So that is something to keep in mind, that 20% is for someone who is non-resident, i.e. paying someone abroad from Vietnam, paying an individual, you will have 20%. So just touching on tax residency, someone who is tax resident individual in Vietnam, so if a director is coming in and out of country, if a legal representative is coming in and out of country, they become resident, and this becomes difficult if they are in country more than 183 days in a calendar year, or the first year of in and out. They have an address in Vietnam, either a temporary resident card or a permanent resident card, or they lease a house, hotel, office from, and where they stay for more than 183 days, even if they're not residing there. The leasing can actually make them tax resident. They can also be deemed tax resident if they can't deem their tax resident somewhere else if they're less than 183 days. So if you are tax resident in Vietnam, even if you're tax resident somewhere else, if you satisfy both, the authorities in Vietnam will treat you as resident and tax you on worldwide income. So, but simply by saying I'm still resident in Singapore, tax resident, and you meet the tax residency in Vietnam, you can be double taxed on worldwide income. Now, there is the double tax agreement. You need to invoke that prior to your situation occurring. It is not completely straightforward. There are caveats in there about who has taxing rights, and this is where you need a professional. But we have seen many people take the view that they are, because they're tax resident of the country, they don't have to worry about Vietnam. That is incorrect. So if you're investing in Vietnam, spending time in country, please protect your situation regarding your residency and where you want to be taxed, where you are residing, and taking advantage of any double tax agreements that may arise, because you don't want to be caught out otherwise. That's the end of my formal presentation. I don't think Asha's quite on the line yet. So Alan's on the phone. So I'm just going to go back and touch on a couple of things. Alan, you had some questions there that you wanted to ask. Do you want to fire at me any of the Vietnam questions?
Not at the moment, Matt. I think we, due to the technical difficulties and challenges, we're going to put Asha on speaker so that she can share her piece as well still. So I'm going to give it a shot right now.
Okay, perfect.
Asha.
I'll stop sharing.
All right. Could you try speaking, please, Asha?
Yeah, hi. Can you hear me?
Yes,
can we hear Asha?
Yeah, we can hear you well.
Me?
All good.
Hello?
Can we hear Asha from there?
Hi.
Yes.
Alan, can you?
Yes, we can. Please proceed, Asha. I'll present the slide on your behalf, and then we can share it through them.
Sure. Hi, everyone. I'm really sorry, but I'm facing some issues with this login. It's my first webinar. I've done this so many times, so I'm a bit embarrassed that I'm not able to log in. What I'm going to tell you is about information for registering a business in Singapore. Can we go to the third slide, please?
Okay.
Yeah. I'll introduce myself properly, but because we're short of time, let's move to the slides first.
All right, we are at slide 3.
Yeah. So everyone asks, saying, why would you register a company or a business in Singapore? Some of the answers are almost like self-explanatory. It's got a stable government. Singapore became independent in 1965. 50 plus years down the line, it's still ruled by the same ruling party, PAP. And this means that a lot of policies can be seen through when the government initiates a policy, it can see it through the results. The government is very, very proactive for business, realizes that this is a small country, and because it's a small country, it needs to be very attractive for business. Its policies need to be attractive to induce or entice companies to come here, these corporations. The second advantage for incorporating in Singapore is Singapore comes with very strong, robust legal infrastructure. All the laws have been codified in English. English is the primary language. So with that, if your business runs into a problem, you are sure that you have the legal recourse. It isn't as if the laws are open to interpretation. The other reason Singapore ranks very high on reason why people want to come here is the tax structure. When you set up a company, while you do want to get paid from, but one of the reasons you would like to be in a country which does not tax you on capital gain. So whenever there is an exit, if you invested at $1,000 and sell for 50, there's no tax on the 49,000. The second is there's no tax on dividends, since Singapore only practices a one-tier tax system. The company pays corporate tax on its profits, and then the company can distribute dividends which are tax-free on the shareholders. Some years ago, to attract smaller businesses to come to Singapore, the government loosened all the rules for audit requirement. Many companies in Singapore no longer need an audit, because if you're a small SME audit, you meet the criteria, which is very, very easy. 10 million turnover, assets of 10 million, or employees over 50. If you meet two of these requirements, you would need an audit. Otherwise, you don't need to present audited accounts. Another reason why Singapore is very attractive is, unlike many other countries in Asia, 100% foreign shareholding is possible. You do not need a local partner. Needless to say, Singapore has become an excellent banking hub. It's modeled itself after Switzerland. So it considers itself Switzerland of Asia. All the banks have offices here, and banking is really easy. Again, Singapore allows repatriation of profits. There is no rule saying on currency control. The government, as part of the proactive policies that I mentioned, has offered a range of government grants. Apart from getting government grants, there's a, should we say, very strong network of venture capitalists here. So it's easy. And a lot of companies in the region come to Singapore to raise capital. Singapore government has also instituted a lot of DTAs. So doing business with any country in Asia, but around the world, is a lot easier because there's existing double taxation treaties available. Most of all, Singapore has an excellent airport, Changi, and that allows business travel. Right now, not so much with the COVID, but in normal circumstances, it's an excellent connection to anywhere in the region. Alan, can we go to the next slide, please?
All right, next slide.
Yeah. So apart from all the commercial advantages that I mentioned, it's also an excellent, Singapore is a very attractive destination because of lifestyle factors, should we say. First of all, you don't need to learn a foreign language. English is spoken and everyone understands English. The second is, it is a really secure environment. Crime rate is, well, we say there is no crime. The government says, oh, it's very low crime rate, but it is lifestyle, excellent healthcare infrastructure, great schools, international schools for from Japan to Germany to US. All the schools have, all the countries have their own schools here. So it's really easy. Your child could be studying on the same environment as your home country. And there's a lot of choice in accommodation. You could live in a small apartment. You could get a lovely house with a swimming pool. So there is a lot of choice available. Another factor why I feel a lot of clients look at Singapore is because if you meet the requirements, Singapore still offers residency, permanent residence, which can then translate into citizenship. In this connection, I'd like to say Singapore passport was ranked number 2 in the world for 2020. I think the one that's above Singapore is Germany, but that's, for a small country, that's a great achievement. Location, like I mentioned earlier, Singapore is the gateway to Asia. You could use Singapore as the base for your company, but travel to the whole ASEAN region or beyond because of for leisure, business, all of that. So that's another reason why people like to consider Singapore as a base for their companies. Can we move to the next slide, please?
All right.
Yeah. Now, when you're thinking of setting up an office in Singapore, there are many structures you can consider. You may look at a representative office. A representative office is basically not allowed to trade, but it is allowed to do market research, business development, research on business development. And the advantage is that there is no legal status, so you do not need to worry about any compliance. You go into an organization called Singapore Enterprise and register. Normally, if approved, you can be a representative office for 3 years. You renew it each year. But it's a very cheap way to enter Singapore to assess whether there is a demand for your kind of business. The second option is to set up a private limited company. And a private limited company is the one that we see the most commonly because it's easy to set up. You can you can get employment passes for the foreign directors, employees. So social charities. So this is an option. There is also a limited liability company. The limited liability company or a private limited company, there's very little difference except that the shareholders' liabilities are limited as set out in the Constitution. So can we move to the next slide?
Okay.
Yeah. So when you register a company in Singapore, the information that you need to provide your service provider is very, very simple. You need definitely a local director. A local director is a Singaporean or a permanent resident or an employee of the company. So that can only happen after the company is incorporated. So you would need to start with a citizen or a permanent resident. That is a must. As I mentioned earlier, we do not need a foreign shareholder, but Singapore regulations require a local director. The company secretary is a legal requirement. A registered office is a legal requirement. And the registered office should not be a post office box like you can in Dubai and other countries. In Singapore, it has to be a brick and mortar office. We need information on the company's activity. Normally, a company is allowed to have 2 activities, and there's a wide range of options that you can choose from, and we can always find something that would be correct, fit your requirements. The share capital. Interestingly, you can incorporate a Singapore company with just 1 share for $1. However, obviously $1 is not going to get you very far, and the bank account opening would be difficult with $1. So we would recommend a higher amount, but legally it is possible to incorporate a company with $1. So the process, Alan, can we move to the next slide, please?
All right, done.
Yeah. The incorporation process is also very, very simple. The information that I listed earlier in the previous slide, we need to collect all the information from you. Then we would reserve the name with the Accounting and Regulatory Authority of Singapore, which is short ACRA. And then we would prepare the documents which need signatures. Fortunately, for a lot of our clients who live overseas, we can, Singapore has passed the Electronic Signatures Act, so we can actually, you don't need to travel to Singapore to sign these documents. We can share them with you through DocuSign, email them. Once they're signed, they would come back to us, and then we can proceed to incorporate the company with ACRA. Once the company is incorporated, we would set up something called a Corp Pass. A Corp Pass is an access to all Singapore government websites. So every company needs to set this up so that they can proceed to the next step of activities. So you may need the Corp Pass to register for filing your tax returns, paying your employees' social security, provident fund contributions, and so on. And obviously, the last part of the incorporation process would be to open a bank account. There, Singapore again is very, very easy. Apart from the 3 local banks, which is DBS, UOB, and OCBC, most foreign banks are operating in Singapore, and you can choose to open bank accounts with any of them. And the documentation requirement isn't very onerous. It's passport, proof of address. If you have a corporate shareholder, you'd need to provide this up to the ultimate beneficiary owner. Apart from that, most banks have a requirement of an average minimum balance of 10,000 to 50,000, depending on which bank. The foreign banks are higher end, the local banks are at the lower end. The process, the timing to open the bank account is around 3 to 4 4 weeks. It used to be faster, but with increased KYC, now banks take about 3 to 4 weeks. So you need to factor that in. We'll move to the next slide, please, Alan.
Yes, Asha. Just a word to the participants. We have opened up our chat, so you can feel free to post your questions for the seasoned attendees for webinars. We are really receiving some questions, so thank you for that. All right, next slide, Asha.
Sure. Yeah. So once the company is incorporated, you should be aware of the legal compliances. So the legal compliances is, of course, the company must maintain accounts, and Singapore allows the company to maintain accounts in whatever currency it functions in. So you could be a Singaporean company but use only US dollar as a currency. You know, you're invoicing in US dollar, you're paying your suppliers in US dollars, you can maintain your accounts in US dollars. Which is unusual because most countries do not allow that, but Singapore wants to be very international. We have clients who maintain accounts in euro, US dollars, and so on. At the end of the year, the company would need to hold an AGM to approve the financial statements. After that, it would need to file an annual return. This is just once a year, and if the company is a small company with individual shareholders, the filing is simply a confirmation that the company has maintained the accounts, the data with ACRA is up to date, and that's it. You pay the fee, and you don't actually have to disclose any financial figures to ACRA unless you have a corporate shareholder. If you do, then you need to file the annual return in XBRL. The company also needs to file an estimated tax return, which is 3 months after year end, and the final tax return, which is within the next 12 months of the year end, with a deadline by 15th of December of the subsequent year. So if your financial year ended, let's say, on the 31st of December 2019, you need to file it by 30th November of 2020. Singapore is a rich country, as I'm sure you've all heard. So Singapore does not take any tax in advance. Even the estimated tax return is filed 3 months after year end. And if you choose to file the estimated tax return, you can claim installment payment without any interest. So that's kind of an interesting point of view for tax compliance, because the government makes it so easy for people to file their tax return. I have a little more information on the next slides for the tax rates. Alan, can we move?
All right.
Yeah. So the corporate tax rate is 17%, and it's just a flat rate. There are no slabs. However, for the first $200,000 of your profit, right, the government gives very attractive tax exemptions. The table in blue is for companies for the first 3 years after incorporation, where even though you would have $200,000 of taxable profit, you would only pay tax on $75,000 because $125,000 would be exempt for tax. Literally, you would end up paying tax of about 6% for the first 3 years on a profit of $200,000. Taxable profit. That's after all your expenses have been in. After 3 years, the tax exemptions reduce, but still from $102,000 is still exempt from tax, and you pay tax at about 8% on that. Apart from these tax exemptions, the government periodically gives tax rebates. So if you have $10,000 to tax to be paid, then it would say 20% off in a year, 15%, depending on how the economy is doing. We're expecting, because of COVID, to get a 25% rebate next year. The GST, Singapore has a 7% current GST taxable rate. The government had announced an increase, which was going to be gradual from 7 to 10 over the next 3 or 4 years. But because of COVID, this is being deferred and will come into place maybe in 2021 or 22. However, GST registration is only compulsory for companies that have a turnover of 1 million. If you're a small company and you're not registered for, if your turnover is less than 1 million, you do not need to register for GST. I had also mentioned that in one of the previous slides that Singapore has a lot of DTAs signed for around the world, and so usually there is no withholding tax as well for a lot of countries. So that's another advantage. I've also got a slide for personal tax rate in case you would set up the company and then get an employment pass and move to Singapore. So, Alan, if we move to the next slide.
Yep, we're there.
Yeah. So the lowest rate, the lowest slab is 20,000, where there is zero tax. The next 10,000, the tax rate is 2%. So the highest rate is 22%, and because of the progressive rates of tax, at 320,000, the tax is 44,500, which actually works to about 13+%. So it's still a very low tax rate for individuals. And this is just your employment income. Another advantage of Singapore is that Singapore follows what is called tax territorial basis. So if you had foreign income, it would not be taxed in Singapore. All your foreign dividends, rental income, nothing needs to be declared on your Singapore tax return. It's only Singapore employment income that's taxed according to these rates. Having said that, everyone's like, why am I not in Singapore? There must be some issues. So we look at some downsides for Singapore on the next slide.
All right.
So Singapore is a very small country, and in normal circumstances, there's always a shortage of manpower. Generally, the unemployment rate in Singapore varies between 1 and 2%. Owing to COVID, it has increased and there is more manpower available. But if the economy is functioning normally, your biggest challenge will be to find local manpower. In the past, this was not a big factor because if you didn't find an employee locally, you could just apply to the Ministry of Manpower and get a foreign employee to move to Singapore to work for your company. But for the last 10 years, the government has become stricter. So whenever you file an application, you need to justify why the company needs to hire this person, how many local jobs has the company created, and so on. As I said, it's stricter. It's not impossible, but it is something that you need to be aware when you're thinking of setting up a company in Singapore. Compliance costs, yes. As compared to Thailand, Indonesia, Malaysia, Singapore is definitely a more expensive city. So compliance costs go up. Your salaries for employees, your rentals, everything will be a little higher than around the region. I look at compliance costs as a trade-off. You get so much, then you don't mind paying the little bit of the compliance cost addition. Increased KYC requirements. I've been running Money Matters and Acclaim now for the past 20 years. When we started, we could incorporate the company within a day with very little KYC requirement. Now, because Singapore wants to be recognized around the world very high standards of integrity, legal, so they have burdened corporate secretarial providers with increased KYC requirements. But these are minor problems. If we would look at all the positives, I would still say Singapore remains a very attractive place to set up in Asia. I think that's about it from me. Right. Thank you for listening to me. I'm happy to take your questions.
All right, Asha, thank you. Please stay on the line. Thank you, Asha and Matt, for sharing those very insightful information and to us, our participants here. While the team is gathering the questions at the back end, maybe we can show right now the poll results of the questions that we posted earlier before when we start off this webinar. May, could you share the poll result, please? Right. So for the first questions, we'll ask, in view of the pandemic, would you consider outsourcing key internal functions moving forward? Well, majority would have chosen the choice no change, right? So everyone would like to keep their jobs, I'll say. Second, would you be considering expanding your business to Singapore and Vietnam? Wow, massive 89%. So Singapore and Vietnam seems to be a key market for many of our participants on this webinar. That's a good thing to know. Last but not least, what would stop you from doing so? The majority went for either cost or complexity in country regulations. And that is why we are here, May and Asha, to address all those questions. So thanks for this, May, and thanks for sharing the results. We have some questions that we received. Let me just share them out. All right. So here we go. Right. This is a question for Singapore, Asha.
Yes.
One of the participants said that they face troubles opening up bank accounts for their new business. It seems none of the banks can support remote bank account opening without them physically being here. Do you see the same issues with some of our clients?
No, actually not, because all the banks have instituted Skype calls, webinars to conduct the KYC. We just opened half a dozen accounts in the last 2 or 3 months. And it's all the local banks. It's UOB, it's DBS, it's OCBC. We haven't faced any issues.
Right.
I'm happy to connect you to our banking relationship officers if you require help.
Right. So for the participant who asked us this question, if you would like to further this discussion, just send us an email at the top right-hand corner, info@climb.com. The next question, this is for you, Matt. So the participant heard stories about investors bringing money into Vietnam, but not being able to get the funds back out. So how does this happen, and how can they protect themselves against this?
Yeah, quite common story for those who live the dream. They see how exciting Vietnam is. They see the opportunities. It's during COVID, we've still got positive growth, and we're one of the few countries in the world that can do that. And there's sort of been an average 6% growth rate for Vietnam past 10 years. That's exciting. There's a lot of stuff happening, a lot of opportunity, almost 100 million people. And so people fall trapped to that. They bring money in via personal bank accounts, they send it to friends, and they bring it in and say, the money's here, now I'll start a business. That is, as I mentioned before, recipe for disaster. If money doesn't come through the capital account, there is a loan account for local businesses, which is a form of capital account. Unless they actually come through that account, the money is stuck. And that's really important, to just stop, pause, and make sure you understand the money flows before you fall trapped to the dreams and the excitement of what you can do in Vietnam. And those who bring money in and often can't bring it out through legal means. There are black market means, which would never encourage, that people do use. There's a sort of the money swapping businesses that does exist, that's fraught with danger. So the idea is, just before you enter, do it slowly, get yourself set up. You can go through a corporate structure, and then you can bring it in and take it out with a lot more clarity and a lot more certainty. And so Protecting against into it is don't rush into anything. Don't believe the hype when someone says, don't worry, I can get it back out for you. I need the money next week. Just trust me, we'll get things sorted out later. No, sort it out before you start. So the excitement should not dictate the flow of funds. And that's basically my answer, Alan.
Right. Well, very comprehensive answer, Matt, I would say. So the approach needs to be right from the very beginning rather than handling in between. Thanks for the answer, Matt. Asha, we got another question for Singapore. So the participant is a foreigner and a shareholder of a Singapore entity. So she noted that dividends is not taxable. Is it difficult to transfer such funds out of Singapore? I think this is similar questions to what the question earlier on for Vietnam. They are facing challenges in other investments in other countries. Meaning to say, the client, I mean, the participant right here, saying asking whether is it difficult to transfer the dividends out at the end of the year.
Not at all difficult, because you just do it straight from the bank. You don't even need any approval. So the company just has to pass a resolution approving the dividends, and the accountant would just process the payment.
Right. As the questions are loading, I see one more question that's linked to this. Is there a threshold to an amount or to this amount that can be exempted from capital gains?
No, there is no threshold for the capital gain.
Right. So thank you.
Of course, there is the counter side to it. For example, if you make the sale for a really high value, then you're going to pay stamp duty, but which is a nominal amount on before the payment is made to you, before the share transfer is registered.
Right. Thank you for that, Asha. The next question. This is for you, Matt. So corruption in Vietnam. The perception is that a foreign investor needs to deal with significant levels of corruption. Is this true?
Look, the reality is there is corruption in Vietnam. It is far less than it has been historically. It exists, and it's endemic to sort of the developing economies and the style that where Vietnam's come from. But on the other hand, foreign investors don't need to partake in that. And that's one of the things we tell people is come into market, just don't. If something's going to take 3 weeks and someone says, I can fix it in a week, I know somebody, don't do it. Let that 3 weeks run its course. Understand the time frame, the processes, and you don't have to partake. Leave it into the local economy, leave it as part of the local lifestyle if that's what they choose to do. But as a business, be compliant. One of the mottos of doing business in domicile and a climb here in Vietnam is that we just don't, and we do it compliantly. And every one of our clients is compliant, and it's easier. Because once you start and go down that path of trying to be local and deal with friends and contacts, it's a path you can't get back out of. It's a one-way path. And so there's just this idea of corruption exists. Stay out of it. There is petty things like at the ports. The truck drivers might get blocked and they might get priority to deliver, and it might be a rush and they pay a few dollars to get through. Honestly, that's something that is more relevant to the local business sector, and from a foreign sector, as a rule, just don't start. You don't need to, and there is no requirement. So does corruption exist? Yes. Do you need part of it as a foreign investor? No, you don't. You can just do the right thing, and in most cases, it is something that shouldn't cross your desks.
Right. Thanks for that, Matt. Asha, a question for you. This just came in as the questions keeps loading. So how easy is it to get an EP, an employment pass, for the business owners once you have incorporated a company in Singapore?
The process will take about plan on 3 to 4 months. The company or the client needs to be ready to hire a local athlete. But once done, yes, it's possible. There's no issues. We have done it. The company must start with a decent share capital. A decent share capital we kind of define as enough to sustain the company's costs for a year. So if the founder, the promoter's salary is 10 to 15,000 a month, then the company needs to have the share capital of about 200,000 so that you can demonstrate to MOM that the company has the resources to pay the salary.
Right. So what I'm hearing is that there's a certain guideline they need to follow through in order to get the EP approved, right?
Yes.
Right. Okay. Just one last question. Matt, this just came in. This is for Vietnam. Is a capital reduction possible and straightforward for incorporated companies with a foreign main shareholder? And can a Vietnamese incorporated company send back the proceeds from a capital reduction back to the mother company aboard?
It's definitely possible. I wouldn't say it's the most straightforward thing, but the process exists. We have done capital reductions on a regular basis. It does require make sure that tax compliance, everything's up to date to make sure the authorities don't object to it. But it's not the most difficult thing you can do. And to get the funds, once you have that capital reduction, provided the company brought the money in correctly through that capital account in the first place, you can repatriate that back through the capital account. And so that is feasible. And that was only happened since 2015. Prior to that, it was not a function of law of any note that you could use. And since 2015, that has been a function and can be used. And it's becoming more common now. And the authorities, particularly in Ho Chi Minh City and to a lesser extent Hanoi, are familiar with that and will go through that process. So it is something that you can explore. A number of years ago, probably a different discussion I'll be having now, but it's something that definitely can be done.
Great. We have time for one last question. Asha, this is for Singapore. So for a Singapore entity, is GST registration a must for international trading business?
No, it's not. It becomes a must only if the company's turnover is over $1 million.
Right. So only if the taxable revenue is up to above $1 million, right, per year?
Yeah, that's the threshold. Now, if you are importing goods into Singapore, you could choose to go on a voluntary registration so that you could claim the input GST when the goods come in.
Right. Okay. Thank you very much, Asha. So I think we have ran out of time today, everyone, ladies and gentlemen. So if you should have any further questions, look at the right top-hand corner of the slide, the screen right now, send it to info@climb.com and reach out to us. We'll be happy to answer your questions moving forward from here. So thank you, everyone. Thank you, Matt. Thank you, Asha, for hosting us and having this session with us.
Thank you, Alan.
Thank you, Alan.
Thank you. We'll see you guys soon. Bye-bye.